Hello and welcome back to the channel Implied Investing. I hope you all are having a great day because today we have a very interesting ETF for you. It's called 0DTE by VegaShares, SPX, NDX, RTY, Premium Income ETF. But before we dive in, let me go ahead and give the disclaimers that this is not financial advice. I'm not a financial advisor. This is for entertainment and educational purposes only. Before making any financial decision, please go seek out a qualified financial advisor. So I know it's been about almost a week and a half since I posted my last video, but I always want to try to make sure that I'm bringing value, bringing something interesting to the scene and bringing a unique perspective. And I think that this fits my channel's theme of bringing you guys interesting ETFs. So this is Zero DTE by a very new issuer, VegaShares. This is one of the most innovative ETFs I've ever seen, and here's why. Because it runs options on multiple indexes. Normally you'll get a S&P 500 cover call strategy, you'll get a Nasdaq cover call strategy, and you'll get a Russell cover call strategy. I think only Neos does the Russell cover call strategy, but this combines all three. So let's take a look at a snapshot of the fund, and then we'll get back into it. So this is a very, very new fund. It just launched April 2nd. I'm recording today is April 4th. It has an expense ratio of 0.68%. Um, its closing price 2 days ago was $25.07. It has $1 million under assets under management, which is pretty low. It has weekly distributions and an estimated annual distribution rate of 16.5%. Mind you, this is estimated. I could not find where they said their target distribution rate, but this is just the estimates that I have based off of the options that they're writing and the indexes that they're writing on. So let's take a look at the fund's structure. So 43% of the fund is held in collateral, 55% is long exposure. So that's roughly 30% of each index, and the income layer, the I'm sorry, the call options are written out of the money. Now, it's writing on the indexes, but I know you guys know SPX is the S&P 500, NDX is the Nasdaq, and RUS is the Russell index, but they're writing on those indexes. They're just writing on the miniature version. So the miniature version of SPX is XSP. The miniature version of the Nasdaq is XND, and the miniature version of the Russell is MRUT. So it is those indexes. It's just the miniature versions of it. And the beautiful thing about index options is that they have uh, European style settlements. So there's no early assignment. Now, this ETF does a zero DTE structure, but out of the so that's every day they're writing covered calls, right? That gives them a lot of optionality as to when they want to write. So if the Fed is coming out with a decision, or maybe the president has tweeted something and the markets are crashing, maybe they do this early in the morning and the markets are crashing, they don't have to write those days. They can just well, they can write those days. For a covered call strategy, it makes sense to write those days because the market is likely gonna go down depending on what the news is. But if it's good news and the market's going up, they don't have to write on those days, and it allows the fund to appreciate. Going back to Actually, I want to go back to the last slide. Just to let you know, you're not getting 100% exposure to those markets, because 43% of the fund is collateral, which is just basically T-bills that earns interest. So, but you're getting 30 out of the 55% exposure layer, about 33%, a little less than 33% of each one, 30% of each one. So here's the actual breakdown. It's 31% S&P 500, which is large cap, the 500 large cap companies that undergo the S&P 500 screening layer. Then you have the Nasdaq 100, it's 36% of that, and then the Russell 2000 is 34% of that. Just be aware that because it is doing a covered call strategy, your upside is capped. But but the way they write those options does allow for some participation. They're not using credit call spreads, but they are writing their covered calls out of the money, which is very beneficial. It's not a at the money strategy, which causes massive NAV erosion and um, causes massive NAV erosion and doesn't allow your asset to appreciate. So this does have a tad bit of appreciation with it. As you can see down here, I have a note, and I'll show you guys the actual math that they write their options almost 2% out of the money. So every day the index would need to go up 2% in order for you to be capped out. If it doesn't go up 2%, then you just keep that premium. But mind you, 2% writing 2% out of the money, you are going to be collecting lower premiums than if you're much, much closer to the money. Okay. So how it works, you have long exposure, gains index exposure via deep in the money call options and US Treasury T-bills. It collects premiums. Option buyers pay premiums. This is the fund's income engine paid out weekly. Dynamic allocation, very similar to the GPIX, is that they don't write on all of it and they don't set their strike prices at the same strike position for each index. They use a strike position based on the volatility. So because the Russell is small cap, it has significantly more volatility. So they make that adjustment. So they use a quantitative framework that shifts allocations based on implied volatility and liquidity. They sell 0 DTE or 1 DTE calls each day, sells out of the money call options on SPX, NDX, RTY, expire in the same day or next business day. Mind you, this does cap the upside if the market goes up more than 2%. And they do this every market day that makes sense because it is actively managed. They do have the ability to not write those options. Okay, so the key difference is that it's a triple threat. It is truly the triple threat because it's using all three indexes. Uh, SPY I just uses the S&P 500. QQQI just uses the Nasdaq. And I think is their Neos's Russell 2000, and it is just that one fund. But with this one fund, you're getting exposure to all three indexes, and they have different levels of volatility. As you know, the Nasdaq has more volatility than the S&P 500, so you are going to be receiving those higher premiums. Dynamic call allocation, multi-index diversification, and because they are writing on the indexes, you know you're going to get that sweet, sweet 1256 tax treatment. So that's 60% long-term gains and 40% short-term gains. Now, because this fund hasn't made any distributions yet, we don't know how much of it may be ROC or return of capital, good return of capital, not destructive return of capital. We just don't know yet. All right, so let's take a look at the options. So the S&P options, when I pulled it today, and I went back and looked at the market data for the second. The S&P options were written 1.87% out of the money. The Nasdaq options were written 2.03% out of the money, and the Russell was written 2.85% out of the money. So one of the things, and I already said it, but I don't mind repeating myself, the market would need to go up 1.8, 2.3, and 2.85 for you to be capped out, right? And even if it does go up, you still get that appreciation, that 2% appreciation. And it needs to go up that much in one day. And if you guys have been paying attention to the markets, they've mostly been going down. And if they go up, it's like 0.5 or maybe even 1%. So these options are pretty safe. Just know that the further away they write them out of the money, the less likely, well, the less premium that they're collecting. And based on this premium collection, that's where that 16.5% distribution rate comes from. So it's a little bit better than some funds and a little bit worse than other funds. But we'll find out for sure what their distribution rate is after they make their first payment. And it is a weekly payer. It is a weekly payer. All right. So about 14% of the I'm sorry, the the income, about 1.8% is coming from those T bills, and out of the annual estimated income, if they run option spreads, 252 market days, they'll be earning about $147,000 um, annually. If you break that up, you get, I'm sorry, if you add that together, you get $165,000 in estimated income, which correlates to a 16.5% distribution rate. Now, here's an important caveat. If they decide that they're going to do more than 16.5%, you may be looking at NAV erosion, or their options writing strategy is changing. They may decide that, hey, I'm going to go closer to the money so I can get more premium. It is a little bit more risky, but this strategy can actually sustain its distribution rate as long as it's in this 16 to 17.5 range. It can actually do it. Anything above that, like if you're trying to get 20-25% out of these indexes, they're probably not going to be able to do that. So just keep that in mind when the actual numbers come out. And also, this does depend a lot on the volatility, because you are harvesting volatility to pay these distributions. These are not typical dividends that companies pay out. This is actual volatility, and they can harvest it and pay you your premiums. So this is how the fund competes against other funds in its category. Here's its peer comparison. So you have Zero DTE by Roundhill, XDTE by Roundhill, RDTE by Roundhill, SPY-I, and QQQI. They all use the covered call strategy. NEOS uses covered call spreads. Distribution, its pricing is very much so in line with the NEOS products, and its distribution rate is very much in line with kind of the Neos and maybe XDTE. So Neos does 30-day spreads, cover call spreads, Roundhill, and these particular products are using zero DTE. I should have put TDAC in here. I don't know why I didn't, but doesn't matter. Uh, its 16.5 distribution rate is right there in the middle between TDAC and uh, T SPY, but it's actually gives you a higher distribution rate than the Neos products. But the Neos products are covered call spreads. This fund is using regular covered calls, and Neos is known for potential for capital appreciation when the market moves up, and it's priced very similarly, very in the same price range. Okay, we said, we tapped on this earlier. It does use those 1256 contracts, which means that you will be taxed at 60% long-term capital gains and 40% short-term capital gains, but you probably won't have to pay any tax on your gains until you have reached your cost basis. So that is very good, because there gives you a lot of options for tax loss harvesting and return of capital, depending on how the fund does the tax loss harvesting to give you return of capital. Because there will be losses. The fund will lose some things in it, and hopefully they hire the right accountants who can register that as return of capital. Okay, 5 reasons to buy. It is the first multi-index zero DTE strategy. It provides weekly income at 1256 tax treatment. It has lower costs than most of those Roundhill funds. It uses smart dynamic allocation, so it doesn't just pick static strike prices. It's not so systematic. It does adjust for how the market moves, and a killer ticker. Zero DTE is very easy to memorize. Here's 5 reasons not to buy. It has no track record. This ETF, this ETF VegaShares, this is their first ETF that they've ever released. It only has $1 million under management. Remember, it does cap your upside in bull markets at that 2%, roughly 2% range. And zero DTE is a real risk. It's very sensitive to inter trading day moves. Um so if the market tears, you are capped out. And that's about all I wanted to say about this ETF. I do think that this is like really one of the fourth generation ETFs. While it only uses covered call strategies, it's a very interesting take on the zero DTE covered call. I think that this VegaShares, if they start coming out with other products, I hope that they keep this level of innovation because I do like seeing these almost all in one fund. It's like, why do I have to go buy three different strategies, three different expense ratios to get exposure to the broad market? Everybody on this channel knows that I'm a huge fan. Well, I have a love-hate relationship with the ETF GIAX, but if because it uses this split formula for its portfolio. It's half ETFs and half individual stocks. And it's diversified. So I really want to find something that does kind of has that strategy, but has competent option writers. And because this is going to give me exposure to the S&P 500, the Russell, and the Nasdaq all in one fund, and an options overlay on top of it. I'm really excited about this fund, and I'm really excited about this fund issuer. Where this might fit in your portfolio, if if you are already an investor, I think this is really good for people who are just starting and are unsure. Hey, do I invest in the S&P? Do I invest in the Nasdaq? Do I invest in the Russell? Well, you don't have to select anymore. You can just go with this one fund. Gives you all of that access, and also gives you a what appears to be a very competent zero DTE covered call strategy. I would like it if they wrote in their prospectus that they could use put credit spread. So when the market's going up, you can write on it. Typically, the small cap is, as of late, small cap has been lagging large cap. So it would be very interesting if they would write that into their strategy that they could use those type of options in order to generate more income. And maybe they add another index like one of the Asian market indexes or European market index or developed market index. It'd be very interesting to see if they added those. That would give you a really complete portfolio plus an income overlay. So if you're just starting out and don't know what to invest in, but you're interested in income investing, I think that this is an excellent choice. With that, I'm going to go ahead and end the video. Forgot to say this. I meant to say it at the beginning, but please like, subscribe, leave your questions in the comments and hit the bell notifications to know when I drop new videos. But with that, God bless and you guys have a wonderful day.